On this video, I want to explain to you what is dollar cost averaging investment approach. So this is just one approach of investment of many. On this approach, you surrender to the fact that you cannot time or don't have a clue of how to time the market, which in fact by many authors of many books, for example, like the author of this book, The Intelligent Investor, suggests that most people, basically everyone, have absolutely no clue on how to time the market, and therefore the intelligent investor should not even attempt to do so. So how does the dollar cost average approach works from a high overview? So basically what you do is you buy the same thing over and over again for a long period of time. You buy this with a certain frequency. For example, 2 weeks, a month, whatever that frequency may be. You just keep buying for 20, 30 years at least, or whatever long period of time you prefer. And basically at the end, the average cost, the average price that you bought will end up giving you a profit. That means that there will be times you bought low and there will be times you bought high, but the average result will end up yielding you a profit. Normally, of this approach, you can expect a 6%, 7, 8, maybe a 9% return on your long-term investment. Now, let's dive a little bit more in details of how this works. So, for example, assume that you start buying whatever stocks or index funds or an ETF right now. The market is at a neutral state. You start buying and you buy for a whole year. Then after that year, the market starts going into a recession and crashes. So the price goes down. During the whole time, you just keep buying. Now that the market is at its bottom, you continually buy, and every time the price that you are buying, it's lower and lower and lower. Temporarily, in the short term, you might be experiencing losses. However, you continue doing the exact same behavior, and then the market, after a few years, starts going up. Things get a lot better, the economy improves, and the stock prices reflect so, and they go high. You, at all points, you kept buying. That means every time you buy, although every time you're buying at a higher price, because you previously bought at the very low price during the bottom of the recession, now you're starting to having good profits. It will get to the point where prices will be overinflated. At that moment, you also keep buying because you have no clue with this approach of what the market is going to do. And basically, you just do that continuously for a long period of time. You buy when things are low, you buy when things are high, and you also buy when things are quote unquote neutral. Basically, you are relying that because of the improvement of technology, innovation, companies' business productivities, the whole market has an upward trend that long-term will give you your expected return. With this approach, you are surrendered to the fact that you must keep buying at all times and you cannot sell until basically the end of your investment, pretty much when you are close to your retirement age after 30 or 40 years of investing. The one thing that you need to keep in mind is that this approach does rely on the discipline of the person that is investing. That means that you cannot stop buying when the market crashes. You need to hold your emotions, you need to control them, and you need to keep buying. Also, when the prices are high, you cannot sell. You need to be disciplined. You need to control your emotions and you need to keep buying and not selling. If you do stop buying or if you do sell, what it does is it ruins your investment because potentially you miss the opportunity to buy at slow or you miss the opportunity to quote unquote sell at its highest. With this approach, what you do need to understand is that it is very boring. Most people, when they think of investment, the image that comes to the mind is of the Wolf of Wall Street, the movie, pictures of that movie that they have like 1,000 screens, they are performing trades every second, and dollar cost averaging, it's the exact opposite of that. It is very unexciting, it's very boring, it's repetitive, you're doing the exact same thing, buying perhaps the exact theme for 30 years. And that it's a boring and exciting behavior. However, it does work. Obviously, with the realistic profits of 6, 7, 8, perhaps 9% return on your investment. This also means because you are having that realistic return is that you are missing out the opportunities of a high profit margin of, for example, let's say someone happens to buy when the market were at rock bottom and then happened to sell it when the market was at the top, and they did an amazing profit margin, and then they appear in all of the front cover of the magazines. With this approach, you are accepting that you will pass on those opportunities because dollar cost averaging basically does not allow you to time the market and for those things to happen. However, you do need to understand that when those things happen, it's actually one person in many millions, because most of the books, or all of the books that basically advise you against doing that, they attribute the fact that if you do it, it was basically because of luck, not because you were a good investor. All of these books truly say that no one has the ability to time the market, and people who attempted to do that did not succeed, and if they succeed was for a very short period of time and were not able to hold it for a long time. That book specifically also recommends that if you do go for this investment approach, you buy what he calls stock markets index funds or a stock markets ETF instead of individual stocks. It also says that people who succeed buying individual stocks and actually make significant amount of money, it's because they do have privileged information that the average person like me and perhaps you do not have the ability to acquire and will not be able to acquire in our lifetime. Therefore, we are much better off accepting the fact that individual stocks might just not be the best investment for us. The best investment will be dollar cost averaging with total stock markets indexes. Lastly, the last thing I want to tell you is that this approach can be considered the best lazy approach for the average person. When I mean lazy, it's because with this approach, the best thing you can do is that you automate the buying of the stocks. Basically, a computer will do it for you and you don't have to do it manually every time. Because you delegate this to the computer, you don't have to do anything. You can just sit back and relax, and therefore it's very passive, it's very lazy. Also, because it's automated and you don't have to actively involve on doing it, you now have time to go and do something else. Perhaps you use your times to figure out ways to generate more money, and then you, with the money that you generate, you then plug it into this investment approach. But at least you have the time, and then you can decide to do whatever you want to do with that time, instead of actively trading and having to invest on all of your time in deciding what to buy, when to buy, and all that involves in active trading. So that's the reason why this approach, it's generally speaking the best approach for people that will prefer a more lazy or passive approach to investment, or for those of us who accept that we just won't be able to time the market and we just want a realistic return for our investment. So I hope you find this video useful. If you like it, please give it a like and subscribe to the channel. I will see you on the next video.